Hello everyone, it's Elliot Yu here with the Free Market Speculator and Smart Bonds, and welcome to my Sunday Deep Dive. Now in this weekly video, we take a look at a key chart, a key trend or indicator that caught my eye over the past week, and I explain what I think it means for markets. This week, there was really no contest for the chart of the week. It's this. This chart shows the yield on the 30-year US Treasury bond since the end of 2020. And as you can see, we closed at a fresh high for the current cycle on Friday. Now, if you squint, you can probably see that the close on Friday was at 5.128%, which is slightly above the closing highs of 5.103% on October 19th, 2023, and last year's closing high, which was set on May 21st at 5.09%. More broadly, you can see that the close was a few basis points above that red shaded region I've drawn on my chart. That's sort of a technical resistance level that's been in place since those late 2023 highs. Let's zoom out. Same chart, except I'm now showing you the yield since the end of '99. Now, as you can see, yields on the 30-year Treasury haven't been this elevated in about 19 years, since the summer of 2007. Note that the yield on the 10-year Treasury also jumped last week. So as you can see here, the yield on the 10-year ramped about 23 basis points. Actually, it was 0.231% to be exact, compared to just an 18 basis point rise in the 30-year yields. The key difference is that the 10-year yield at 4.595%, well, that remains below the highs we saw in the summer of last year. And that 4.99% cycle peak, almost 5% peak, we saw back in October 2023, October 19th, 2023 to be specific. Now, obviously, this is important for the bond market, which is why I'm posting this Sunday Deep Dive to both the Free Market Speculator and Smart Bonds this weekend. However, it's every bit as important for those of you who might not have much exposure to bonds at all, but you're exposed to stocks and commodities. So first up, whenever I see a breakout like this, a breakout in yield and by extension a break lower in bond prices, in this case, I like to step back and try to determine what's behind the move. Now, there were plenty of potential catalysts last week, right? Including a hot consumer price inflation or consumer price index inflation report, CPI report, released on Tuesday morning at 8:30 a.m. Eastern Time. And of course, a higher than expected inflation print on PPI, Producer Price Index, inflation on Wednesday morning, also at 8:30 a.m. However, from the close on Friday, May 8th, through the close on Thursday, May 14th, 30-year yields were up just 6.5 basis points, and 10-year yields were up 9.7 basis points, right? So not much. Most of the big rise in both the 10-year and the 30-year Treasury came right at the end of the week. Now, that timing is very interesting because it strongly suggests it was due to disappointment surrounding the outcome of talks between President Trump and Chinese President Xi in Beijing. Now, the official readout from the summit from China's state media, well, that hit the news wires between about 2 a.m. and 4 a.m. Eastern Time on Thursday morning, so very early Thursday morning, which was afternoon in Beijing. While the US readout account was released a bit later on Thursday morning, right around 8 a.m. Eastern Time. So I want to start with a line from the Chinese state media readout that captured a lot of attention, and I'm quoting here from the English translation. "The Taiwan question is the most important issue in China-US relations. If it is handled properly, the bilateral relationship will enjoy overall stability. Otherwise, the two countries will have clashes and even conflicts, putting the entire relationship in great jeopardy." Now, that was considered rather aggressive framing from Chinese officials' media, China's official media. Now, regarding Iran specifically, the Chinese stated, quote, "China is willing to strengthen strategic communication with the US to jointly push for a comprehensive, fair, and lasting resolution to regional hotspot issues, while respecting the sovereignty and security of all countries involved." So this differed quite a lot from what the US readout had to say about Iran. The US readout was much more optimistic on Iran and the Strait of Hormuz directly. And I quote from that readout, quote, President Xi made clear China's opposition to the militarization of the Strait and any effort to charge a toll for its use. And he expressed interest in purchasing more American crude oil to reduce China's future structural dependence on the passage. However, notably absent from either account was any sort of announcement regarding an official policy or a mechanism of some sort for reopening the Strait of Hormuz. Now, markets had been anticipating that China might be willing to pressure Iran to reopen the strait, since China is, of course, a major buyer of Iranian oil exports. And while the US readout also references China's increased investment in key US industrial sectors, there were no specific commitments to, for example, buy agricultural products like soybeans or corn, as some had anticipated, and as we got following some agreements during Donald Trump's first term as president. So the timing is interesting because a lot of media commentators I've seen attributed the spike we saw in yields right at the end of last week to the CPI and PPI numbers. But the timing is interesting because I think it had a lot more to do with the outcome of the China-US summit. Brent oil, for example, bottomed out between 7:30 and 8 a.m. Eastern time on Thursday morning. And it was trading at that point around $104.50 a barrel and embarked on an almost uninterrupted rally to end the week, right? Ending Friday's session near the highs for the week around $109.50 a barrel. So a $5 rally there. Now, soybean prices, which were buoyed early in the week by a positive USDA report, there was the World Agricultural Supply and Demand Estimates, or WASDE, release. I know some of you trade agricultural commodities. You're probably very familiar with it, as I am. That's released on Tuesday at noon Eastern time, right? So all these agricultural commodities rallied based on that, but they sold off hard in the second half of the week. So on Wednesday, beans closed at around $12.27 a bushel, right? Selling off to under $11.90 on Thursday, and they actually logged a lower low of $11.72 on Friday before recovering slightly to $1.77 a bushel by the close, which is 2:20 p.m. Eastern time for agricultural commodities. So that's a clear sign of disappointment regarding any sort of Chinese agreement on the Strait of Hormuz and any specific commitment to buy soybeans from the United States. And I think particularly crucial for today's deep dive, the yield on 10-year government bonds, and I'm looking at the futures here, actually hit a low of 4.44% at 8 a.m. on the morning of Thursday, May 14th, and then shot higher to 4.597% by the close on Friday, May 15th. 30-year Treasury yields bottomed a bit later at just under 5% around 11 a.m. on Thursday, May 14th, and then traded sharply higher also through the close on Friday afternoon, May 15th. Now take a look at this chart. And this one, I'd argue, represents the clearest signal of risk-off behavior in markets right now and concerns about the Middle East. This is a chart of the euro and the British pound against the US dollar since the start of 2026 this year. Specifically, these lines are the front month futures contracts for both currencies. Now, as you can see, both the euro and the pound plunged at the end of last week against the dollar. Importantly, both currencies broke down through some key support levels at the mid-March highs, which I've drawn here. For the euro in red here, that horizontal support line I've drawn, it was around 116.5, and the euro closed at 116.2. The pound pictured here in blue was even weaker at the end of last week, closing at 133.2 under that horizontal support line I've drawn at about 134.5. So I suspect the pound was a little weaker than the euro due in part to the ongoing fallout from the ruling Labour Party's stunning defeat in local and devolved elections on May 7th. UK Prime Minister Keir Starmer's party lost over 1,000 council seats. These are local government elections across England, right? And got pushed into third place in Wales. As a result, he's under immense pressure to resign. And Wes Streeting, who's widely viewed as a leading candidate to replace Starmer as head of the Labour Party and Prime Minister, well, he actually resigned as a cabinet minister in the Starmer government on Thursday, May 14th, last Thursday. But regardless of the UK political drama, which is ongoing, the dollar is widely viewed as a haven amid market turmoil and political storms. And the euro, the pound, the yen all started the weekend dramatically between 8:30 and 10:30 a.m. US time on Thursday morning. Again, this lines up well with the pattern I've discussed in these other markets. Now here's another market to watch. This chart shows front month NYMEX silver futures so far this year. As you can see, silver broke above its mid-March highs early last week. Actually, it was Monday, May 11th, and followed through to the upside, only to reverse sharply lower and tumble back into that range in the final 2 days of the week. This is a daily chart. But does anyone want to guess what time that selling started late last week? Well, silver prices were hovering around $87 to $88 an ounce between 11 p.m. Wednesday night, May 13th, and around 8 a.m. on Thursday, May 14th. But they took a dive between 8:30 and 9 a.m., starting between 8:30 and 9 a.m. Eastern Time, Thursday morning. By 11 p.m. Eastern on Thursday night, silver was trading around $81 or $82 an ounce, tumbling into the mid-70s before the weekend. Simply put, markets were clearly laser-focused on perceived disappointment surrounding the Trump-Xi summit in Beijing. All of the markets I've discussed, including soybeans, crude oil, silver, euros, pounds, the most important of all being treasury yields, they all started to move as the official summit readouts from the Chinese and US sides began to hit the news wires on Thursday morning. That was a defining event last week. And I'd also argue the fact that these late week trends accelerated into the close on Friday, well, that's really not a huge surprise. After all, if markets are worried about the ongoing closure of the Strait of Hormuz and in their risk-off mood, well, weekends when markets are closed represent, a particularly dangerous time. Many of the developments and headlines we've seen regarding the conflict in Iran and the Strait of Hormuz, well, they've occurred over the weekends since the conflict began at the end of February, including the start of Operation Epic Fury. And as I'll explain in just a moment, I believe the late week rally in oil prices last week and the surge in bond yields, well, those two are particularly closely related, as I'll discuss. So I want to run through 3 crucial points about the jump in 30-year Treasury yields to new 19-year highs at the end of last week and the impact on various commodity and currency markets. I think a lot of people are getting this wrong. And a lot of these markets I've just outlined are at the heart of all this. So I'm actually going to cover 2 of those points in this video today. And in the interest of time, I'll get to the 3rd point next week. First, and most important near term, it's a good rule of thumb to be suspicious of breakouts or breakdowns in markets that occur in the context of stretched market sentiment. Okay? And right now, the stagflation trade is already very crowded. In the April Global Fund Manager Survey from Bank of America, 76% of those surveyed said they expect stagflation, which the bank defines as below trend economic growth and above trend inflation. That was up 20 percentage points from the prior month. And just look at this, even more important. This is what we call the DV01. So it's a dollar value of a 1. And it's based on the leveraged fund position in the 2 longest duration Treasury bond futures markets here in the US. Now, I derived this from the Commitment of Traders report released by the CFTC each Friday afternoon. So this was released last Friday, the 15th, and it shows trader positions through the close on Tuesday, May 12th. Now, longtime readers know that I watch the commercial and non-commercial positions for most markets like oil, silver, and natural gas. However, for treasuries, this non-commercial data can be a little misleading because the non-commercial or speculator category includes investors like pension funds, insurance companies, and foreign sovereign wealth funds. Now, these investors are generally active in the Treasury futures market, not because they have a view on rates, but because they want to match the liabilities of their portfolios to duration. So their persistent structural long positions in bonds, well, they distort the true speculator position. So what I do is I like to watch the positioning of leveraged funds. So that's a category in the CFTC's disaggregated commitment of traders report. And it includes true speculators on rates like hedge funds, commodity trading advisors, and managed futures firms. To create this chart, I looked specifically at the leveraged fund net position in the 30-year Treasury futures market and what's known as the ultra 30-year Treasury market. Now, I won't bore you with the exact difference between these two contracts in this video. Suffice it to say that the duration of the 30-year Treasury futures is about 18 years, and the ultra 30s come in more like 25 years. So what that means is that the latter has significant more sensitivity to rates than the former. The ultras are more sensitive to rates. So what I did is I duration adjusted the data, because a net short position in one contract, for example, in the ultras is more aggressive than a bet on rising long-term Treasury rates as a bet on long-term Treasury rates than a similar size position in the classic 30-year futures. So specifically, what you're looking at here is the highest ever net short position in the long end of the Treasury futures market, with data back to 2008. That means for every parallel upward shift in yields of 1 basis point, that's 1/100%, 0.01%, the value of this short position in the long duration treasuries will gain $274.3 million US dollars. So just remember that this is a short position we're talking about, but a rise in yields on bonds represents a decline in bond prices. So it benefits from higher yields, lower bond prices. Now let me put that $274 million per basis point figure into some sort of historical context. These raw dollar figures for futures positioning can be misleading on their face value. That's because the Treasury futures market's much larger today than it was 10 years ago or 5 years ago. So a large short in dollar terms doesn't necessarily mean, the speculators, the specs, are more bearish than they've ever been. So to get a cleaner read, I like to express the duration adjusted net position as what's known as a z-score. So that is how many standard deviations we are away from the 2-year rolling average position. So a positive number, more bullish than average; negative number, more bearish than average. Think of it as a measure of how extreme the current positioning is on rates relative to what these same traders have done over the prior 2 years. Also, again, note that a large bearish position on bonds represents a bet on higher yields. So specifically, what you're looking at here is an ETF, the iShares 20+ year Treasury bond ETF, which trades under the symbol TLT, and it tracks long-term Treasury bond prices, not yields. That's the red line. The blue line is the weekly z-score of that duration-adjusted leveraged long commitment of traders report positions. I've also drawn a purple line at plus 1.5 standard deviations above the mean, bullish, and a green line at negative 1.5 standard deviations below the mean. That would indicate traders are more bearish than normal. So when the blue line is above the horizontal purple line, that means the speculators are very bullish bonds, while a move under the green line signals rather extreme bearish sentiment. Like all indicators, it's not perfect, far from it. But I have drawn some double-sided arrows in there near points of extreme speculative positions, and you can see that they often signal contrarian pain trades. When sentiment is excessive on this basis, the market often moves in the direction that causes the most pain to the most speculators. And that z-score is currently sitting at minus 1.88 standard deviations, placing us in the 9th percentile of all weekly readings going back to 2008. These speculators have been this bearish on long duration treasuries, or more bearish, only about 9% of the time in 18 years of data. Bottom line, we saw long bond yields close at new cycle highs last week, albeit just barely, and we are still below the intraday peaks for yields from 2023 and last year. Still, bonds broke down and yields broke out. Very important to keep that in mind. However, this move is coming in the context of a market that's already very bearish bonds. And with most speculators already betting on the same outcome, it's harder to find new bears to drive further downside in the long bond and further upside in yields. And if there were any whiff of good news or some sort of sudden reversal, for example, a weak jobs report next month, or some deal to reopen the Strait of Hormuz would be a big one. Even just soothing comments from new Fed Chairman Warsh at his first meeting as chair next month in June. Those bearish speculators have a lot of short positions to cover, which is the sort of dynamic that can produce powerful rallies and upside. So I think the next week or two will be critical. If yields remain above this breakout level and push higher, then we have to respect that. However, based on the extreme speculative position here, I believe there's a high probability this breakout fails and yields reverse sharply lower, causing significant pain for those shorts. Here's one more nuance worth flagging. The leverage fund positioning across the entire treasury curve is not simply a bet that all yields rise. It is a very specific curve trade. In the 5-year note, that's the belly of the curve, leverage funds are actually at the 97th percentile of their least short positioning in history. Effectively, they're bullish the 5-year. In the 2-year, they are covering their shorts pretty actively. But in the 30-year and ultra 30-year combined, they are at the 9th percentile, near their most bearish reading on record. That's a steepener trade, long the front end, expecting short-term rates to eventually fall or at least not rise much as growth slows, while simultaneously short the long end, expecting the 30-year yield to stay elevated or rise further. That is basically the stagflation trade. It's not the blunt rates go up across the board view. It's a more nuanced, sophisticated positioning that encodes a specific macro thesis. Now, the relevant historical analogs for this exact positioning pattern, that's when leverage funds are simultaneously near a record least short in the 5-year and near a record most short in the 30s and ultras. They cluster into two basic regimes, two periods. The post-financial crisis period of 2010 to 2011 and the post-taper normalization period of 2014. In both cases, TLT produced strong returns over the following 26 to 52 weeks. The one exception was 2022, which was an outlier year in many ways. We saw very high inflation going into that, a Fed that was way behind the curve, hiked interest rates by 4.25% in a single year. Very different regime to what we're seeing right now. So that brings me to my second point, and it's one that I think gets almost completely lost in the narrative around bonds and inflation. And that's the idea that commodities up means yields up, bonds down. Frankly, that's an oversimplification that the data doesn't support. And I want to show you exactly why. As long-term readers and viewers know, I believe in the commodity supercycle is underway right now and has been for the last couple of years. I've written about the turn of what I call the Great Cycle multiple times over the past 18 months. And I believe we're entering a period more like the 1970s or the 2000s, which supports a weaker dollar, stronger commodity prices, and acts as a tailwind for global markets and emerging markets. However, a bullish view on commodities does not imply a long-term bearish view on bonds, a view that rates are headed much higher. The narrative you're hearing over and over right now goes something like this. Commodities are up, therefore inflation is back, therefore bonds are going to keep selling off. Therefore stay short duration and stay short TLT. That's a massive oversimplification. And the data simply does not, as I said, back it up. And I think it matters because a lot of investors are getting fed this narrative as if it is settled economics when the reality is far more interesting. Now, so I went back and calculated the correlation between each of the major commodity markets and TLT. So that's that long treasury ETF over the full period from 2002 through today. And here's what I found. The data on your screen right now presents it. So the CRB index, that's the broad commodity benchmark, that has a correlation of minus 0.23 versus TLT going back to 2006. Now, negative correlation does mean that when commodities go up, bonds tend to go down, yields tend to go up. And that is the core of the narrative you're hearing, right? But take a look at this. That minus 0.23, that's very weak negative correlation. The R squared of this regression is just 5.1%. Now that means that the broad commodity complex only explains about 5% of the variation in TLT and long bond returns. That leaves 95% of what drives bond prices entirely unexplained by commodity prices. But here's where it gets even more interesting. Break it out by commodity and the picture falls apart completely. Gold has a positive correlation with TLT of plus 0.13% over the full period. I studied over this is more than a 20-year period I studied. Positive. That means gold has historically rallied with bonds. Just look at what happened when rates spiked at the end of last week. Gold sold off with bonds, starting in about that same time frame. Thursday morning, when we got the readouts from the Trump-Xi summit, bonds sold off and gold prices also sold off. Same with silver, as I outlined earlier, even though, as you can see, silver prices have almost zero long-term correlation with TLT over 20 plus years of data. And just look at those R squared values of 1.8% for gold and 0.1% for silver. Changes in gold prices and silver prices over time have very little read-through for bond prices. Soybeans and corn have correlations of minus 0.10 and minus 0.07 respectively versus TLT. Negative? Yes, but very weakly negative. These are not even economically or statistically meaningful relationships at the full period level. And again, this week was instructive. Soybeans were actually up earlier in the week, supported by a bullish USDA supply and demand report that came out on Tuesday, but then they sold off sharply Thursday and Friday after the summit disappointment, right alongside bonds. No commitment from China to buy U.S. agricultural goods, so no specific commitment anyway. So agricultural commodities were positively correlated to bond prices last week. Not a hedge. Bonds and ag sold off together on Thursday and Friday. So which commodities do have a meaningful negative correlation with bonds, meaning they tend to push yields higher when they rally? Oil and copper. Correlation of minus 0.11% over the full period for oil, and negative 0.26% over the past year for oil, and negative 0.15% for the whole period for copper. However, both have pathetically low R squared values, and as you can see from the column labeled historical range, there have been years, long periods of multi-years over this 20 plus year time frame where both of these markets have actually been positively correlated to TLT and bond prices. And late last week, copper prices actually sold off very aggressively right alongside bonds in that same time frame. So, question, can there be a commodity supercycle where bonds also rally? Yes. In fact, that's exactly what happened in the last supercycle from the late 90s to the 2012 to 2014 period, depending upon which commodity you want to look at. These two are not mutually exclusive. And that brings me to my third point, which, as I said, I will cover in more detailed piece next week. And that's really just that I think the idea that bonds sell off when commodities see a supercycle is a vestige of the 70s. The US economy is very different though, and the shale revolution has changed the game. In the 70s, the US energy mix was dominated by oil, and specifically imported oil. In 1978, the peak year for that, oil alone provided more than half of total US energy supply for all uses. Transportation fuel, electricity generation, plastics production. And import dependence was still rising, had been since the mid-60s. Now today, the US is the world's largest oil producer and the world's largest natural gas producer. Now today, oil also is down to about 39% of total US primary energy use, while gas is almost as high as oil at 35.4%. And if you haven't noticed, US natural gas prices are actually near the lows of their range over the past few years. So in my view, the energy inflation transmission mechanism, well, it was weaker in that 1998 to 2014 supercycle than in the 70s, but it's even weaker today as the shale revolution led to a structural decline in US energy import dependence over the past 15 years. Indeed, in the 70s, rising oil and nat gas prices, they were an undeniable negative for the US economy. Today, with growing US oil and natural gas exports, rising oil and global gas prices actually provides offsetting boosts to certain segments of the economy. And not just energy producers, but also industrial sectors that are energy intensive, even technology and AI. Low natural gas prices here in the US relative to Europe, Asia, almost anywhere except the Middle East, which obviously is off the table right now, are huge boosts for the US tech sector. So I want to talk more about these shifts next week, but that's it for my Sunday Deep Dive this week. I hope you enjoyed it and found it useful. If you're not already a paid member to the services, I am going to go ahead and offer 30-day free trials to both the Free Market Speculator, which includes the Energy Bulletin, and the sister publication Smart Bonds through the end of this month. The links to both those free trial offers are below. Thanks again for listening.